Thank you, Legal Sustainability Network members. We're very happy to host a webinar by Agendi today. Before we get started, I just want to remind everyone that there's also a member forum on December the 9th. So please register for that if you haven't already. That's an opportunity for you, our membership, to talk about whatever it is you want to talk about in terms of sustainability. But for today, once again, we're super pleased to have Agendi with Christine and Meninder from Agendi. They're going to talk about about Agendi's consultancy and how they help you become a more sustainable organization. So I'm going to let you both take it from here. Welcome to the Legal Sustainability Network.
Thank you so much, Doug.
Thank you.
I'm going to go ahead and share my screen and see if this works. Okay. Are you all able to see just the deck?
Can see the deck, yes.
Okay, perfect. So hi, everyone. Thank you so much to the Legal Sustainability Network for having us today. My colleague, Christine, and I are excited to walk you through a special webinar for LSN members on an introduction to greenhouse gas accounting and target setting for legal organizations. We really appreciate you taking the time to watch this webinar if you're watching it virtually. And I'll kick us off with some introductions, give you a sense of what to expect in the next 45 minutes. And this webinar is recorded, and we'll also be sure to communicate with LSN to send out this deck as well. And then if there are any questions for folks, please don't hesitate to reach out to us, and we'll make sure to leave our contact information at the end.
And one program note, if you have questions during the presentation, feel free to throw them into the chat, and I will do my best to address those either in real time or at the end of the meeting.
Great. Thank you so much, Doug. I'll go ahead and introduce myself and my co-host. My name is Meninder Kaur. I'm a consultant at Agendi based in Los Angeles. In my role, I help organizations across diverse sectors with developing their ESG strategy, including complex greenhouse gas accounting and sustainability disclosures. I'm joined by my colleague, Christine Kong, who is a senior consultant based in our New York office. She's a veteran sustainability specialist with cross-sectoral proficiency in corporate climate advisory. She's also EcoVadis certified and a subject matter expert on financed emissions. For those that are unfamiliar, Agendi is a sustainability and climate strategy consulting firm with headquarters in North America, UK, and the EU, serving over 200 global clients. We help our clients with a variety of services, including, of course, greenhouse gas accounting and target setting, as well as other offerings such as climate-related risk disclosures, materiality assessments, transition plans, and carbon offsetting strategies, just to name a few. And finally, we hold several accreditations, which you can see at the bottom, including B Corp certification, CDP partnership accreditation, and approved emissions targets. And we have team members certified by EcoVadis and SBTi. For today's discussion, I'll lead us through an introduction to greenhouse gas accounting with specific applicability and relevance for law firms. Afterwards, Christine will provide an overview of environmental and science-based target setting. And then for the last 10 to 15 minutes, if there's a Q&A, we'll be sure to answer that. Otherwise, we can get to that offline as well. Okay, so jumping right into an introduction to greenhouse gas accounting, also known as carbon accounting or measuring your carbon footprint. Before we dive into how to calculate emissions and set targets, I want to take a step back and look at the bigger picture. what carbon accounting enables companies to accomplish. So at its core, measuring emissions or carbon accounting helps companies do three things. The first is report and disclose through voluntary frameworks like GRI or SASB or CDP, which you may have heard of, or regulatory requirements such as California Senate Bill 253, which mandates greenhouse gas emissions disclosure, and any customer requests that you may get. The second is set targets and reduce emissions through initiatives like the Science Based Target Initiative, which aligns reduction goals with climate science. And then finally, assess your climate risks using scenario analysis to evaluate how different climate futures may impact your business in line with frameworks like IFRS or regulations that mandate climate-related risk disclosures, such as California Senate Bill 261. For many years, voluntary reporting has been the main approach companies have taken to disclose their sustainability performance. And this pyramid represents that structure, starting from international goals and networks at the foundation, which have guided how companies measure and report their impacts. In the middle section, we see the variety of voluntary standards and organizations that have shaped corporate sustainability reporting, from frameworks like CDP and GRI to the TCFD. And what we're seeing now is a major shift. These voluntary frameworks are increasingly being built upon and aligned with emerging regulatory requirements, which are shown at the top of the pyramid, like, as I mentioned, California's Climate Accountability Package, CSRD in the EU, and ASRS in Australia. So the good news is that companies that have already been engaging in voluntary disclosures are in a strong position. They can more easily adapt to evolving expectations as new climate regulations, which are informed by these same standards, become required in many regions. And just to give you a sense of scale, over 2,000 companies are now subject to California Senate Bill 253, which, as I mentioned before, mandates you to disclose your greenhouse gas emissions. More than 11,000 companies have approved or committed to set science-based targets, and over 24,000 companies disclose their environmental impacts through CDP. So together, this shows how voluntary and regulatory reporting are converging, and it sets the scene of how widespread the movement toward global transparency has become. So just building on the last slide, we're now seeing a global wave of legislation requiring companies to disclose their greenhouse gas emissions specifically. And it's a trend that we are seeing that continues to accelerate as more countries develop their own corporate climate reporting rules. And so the examples on this slide are just a subset of the many countries with greenhouse gas disclosure requirements, both mandatory and voluntary. So in the US, the main regulation that I've been calling out several times is the Climate Accountability Package in California, specifically Senate Bill 253. Across North America, both Canada and Mexico have also introduced their own greenhouse gas disclosure laws, further aligning the entire region on climate transparency. In Europe, the EU is currently phasing in its Corporate Sustainability Reporting Directive, or CSRD, while the UK has already implemented its own mandatory disclosure framework. What's important to note is that all of these regulations require companies to report Scope 1 and Scope 2 emissions, and most also require Scope 3 emissions, which covers your broader value chain. And in addition, third-party assurance is also increasingly being required to verify these disclosures. So the direction is clear. We're moving from a largely voluntary landscape toward one where regulatory compliance is becoming the norm. To calculate a company's greenhouse gas inventory, we rely on the Greenhouse Gas Protocol, which is the globally recognized standard for corporate emissions accounting and guidance. The protocol defines 3 scopes of emissions to ensure that all business activities are captured. Scope 1 covers your direct emissions from sources that a company owns or controls, such as any vehicles that you own, or any on-site energy use. Scope 2 includes indirect emissions from purchased energy, typically energy that's created off-site, but then used on-site at your facilities, like electricity, for example. And then Scope 3 encompasses all other indirect emissions across your value chain. So this can include emissions from the goods and services the company purchases, employee commuting and business travel, and even the waste that you generate. Together, these three scopes provide a complete picture of an organization's carbon footprint, from direct operations to the broader value chain. Now let's take a closer look at what falls under Scope 1 and Scope 2. As I mentioned, Scope 1 includes any fuel used for energy generation on site. So for example, natural gas that's used for heating in your boilers or generators. It also covers operational fuel used in company-owned vehicles, as well as refrigerant leakages or other fugitive emissions. Scope 2, on the other hand, captures indirect emissions from the purchase of electricity, steam, heating, or cooling. Energy, as I mentioned, that's typically generated off-site and provided by a utility. It can also include fuel consumption that's passed on to your lessees if that fuel use isn't already accounted for in Scope 3. And finally, let's touch on Scope 3, which is the broadest and often most complex category of emissions. Scope 3, includes all other indirect emissions that occur across your company's value chain, which aren't already captured in Scopes 1 and 2. And these emissions are typically interconnected across companies. So in other words, one company's Scope 3 emissions are often another company's Scope 1 and 2, which is why collaboration and transparency across the value chain are so important. And then on the right, you can see the 15 subcategories of Scope 3 divided between upstream and downstream activities. We've highlighted the categories in blue that we believe are the most relevant for law firms, which include purchased goods and services, capital goods, fuel and energy related activities, which is related to Scope 1 and 2, upstream transportation, waste, business travel, employee commuting, and upstream leased assets. While these might not be 100% applicable to every firm, we think that they can serve as a really good starting point in understanding your value chain emissions. So now that we understand the different scopes of emissions, in the next few slides, we're going to talk about the two key components that are used to calculate them. The first being activity data and the second being emission factors. Now, in an ideal world, we'd be able to directly measure the amount of greenhouse gases emitted from each of our business activities. But in most cases, that's not possible, right? We don't have sensors on every process or piece of equipment. So instead, we estimate emissions using what's called an emission factor. So when we multiply the activity data, so for example, the amount of electricity used in kilowatt hours or the dollars spent with a particular supplier, when we multiply that by the corresponding emission factor, which represents the average amount of emissions released per unit of that activity, we get the total estimated emissions. And so these emission factor values are developed and published by major environmental and governmental agencies like the IEA, the UK government, or the US EPA to ensure that there's consistency and accuracy. Let's make this more concrete with an example. Say we burn 20 liters of diesel fuel. If the emission factor for diesel is about 2.7 kilograms of carbon dioxide equivalent per liter of diesel, then we can simply multiply the 20 liters, which is your activity data, by 2.7, which is the emission factor. And that gives us 54 kilograms of carbon dioxide equivalent emitted from that combustion activity. So the math is simple, right? It's just multiplying two numbers together. The challenge in calculating emissions is getting accurate and complete activity data so that we can feel confident in our emissions calculations. And speaking of activity data, the next step is thinking about the quality of that activity data. How can we improve the accuracy of our calculations? The Greenhouse Gas Protocol provides a recommended data hierarchy to help companies prioritize the most accurate data sources. We've summarized it here at a high level, and it's essentially broken down into 3 groups listed in order of preference. First, we have our primary data. This is the most accurate and reliable form of data. It comes directly from the source. So for example, if you have a supplier and they provide emissions data specific to a product or service that you buy, or you have access to the utility invoices for your offices, that would count as primary data. Because it's sourced directly, this type of data can be reliably used to track emissions reductions over time. The next tier down is hybrid data. This combines some direct information, some primary data. So for example, let's say you have access to the number of employees commuting to your offices, and it combines that with an industry average to fill in any gaps. So if we're looking at commuting, we might use the US Census statistics on commuting patterns. Hybrid data can sometimes be used to track reductions, but its reliability depends on how much of it is based on actual versus estimated information. And then finally, we have the spend-based method. This approach uses the dollar amount spent on a product or a service multiplied by an industry average emission factor. This is often the most easy to use, and it's where we typically recommend starting if you're just starting out calculating your inventories, because we know everyone has access to spend data. It's also, on the flip side, the least reliable for tracking emissions reductions, since it depends heavily on averages that might change over time. And the only way to show improvement with this method is by spending less. And we know that's not always practical. So as a best practice, companies should always aim to move up the hierarchy toward more hybrid and primary data to improve the accuracy and credibility of your inventories. I'll end this section with covering 2 examples of categories that might make up the most material portion of your firm's emissions. The first example is purchasing goods and services. So here, the goal of data collection is to capture the cradle to gate emissions. So everything that happens to create the product up until it's ready for use, not including the end of life impacts of that product. You'll also want to account for purchases by the type of vendor and the type of good or service. There are a few practical considerations to keep in mind specifically for law firms. The first is that firm-wide financials often include items that should be excluded from calculations, like rent, taxes, payroll. So ensuring that there's some form of data cleaning happening might be required. And then second, if your operating expenses are spread across many different credit cards, if you provide that to your employees, it can be challenging to separate the spend for the service provided from the type of good purchased. So overall, lesson learned from a lot of our law firm clients is having good bookkeeping. It's really essential to ensure the accuracy and reliability of the data.
And I have a question. So like if a law firm's gonna, one of our members wants to get on board and calculate their carbon footprint, are there steps they could take to like get more primary data ahead of working with you? Like are there, is there some low hanging fruit that you'd recommend our members like try to, you know, to get in order to get that primary data?
Yeah, so I mean, there's so many resources out there. The first one that I would point to people is the Greenhouse Gas Protocol. It provides a really robust methodology and framework for understanding each category of Scope 3 emissions, and it also separates by example how you can calculate with primary, hybrid, and spend-based methods. So I would say if you're not familiar with the Greenhouse Gas Protocol and you're just starting out learning how to calculate an inventory, that's where I would start. If you do have the, of course, budget for it, obviously there's consultancies like ours, but there's also platforms out there that we know of that provide solutions as well. But the Greenhouse Gas Protocol is the best practice guidance, I would say.
Thanks.
That's a great question. So for purchasing goods and services, on the right, we've mapped what kind of data would look like for each of the different data hierarchies. So primary data, right, would be supplier reported emissions or the energy usage related to a purchase good or service. So for example, if you, let's say you do a lot of work with FedEx or you ship out a lot of things from FedEx. I know FedEx provides emissions, end of year emissions calculations for the goods that you ship out with them if you have a business contract with them. So that is something that would be primary data. Hybrid data would include.
I have one user note on that. Like FedEx is super helpful and gives you that data free of charge. Please note that UPS actually charges you for that information.
Okay.
So yeah, it was a real bummer. I hate to call out somebody, but like that was my experience. Like FedEx offered up the information at no cost immediately, and UPS was going to charge us like $3,000 for
Oh, wow.
calculating the carbon footprint. So just a user note on that.
No, thank you so much for calling that out. That is really helpful information to know. And of course, we hope we can get to a point where that information is more readily available to people without having the cost associated with that. So that would be primary data, right? Whether you get it from FedEx or Amazon Web Services or UPS, if you can get the emissions data directly from those suppliers, that would count as primary data. Hybrid data would include supplier-specific data. So let's say you purchase a quantity of goods and you have access to the weight of those goods, but then you combine that with an industry average emission factor. And then finally, spend-based data would include just the dollar value of purchased goods and services. And then the last example that I'll talk through in this section is business travel by employees. We know that for law firms, category 6 or business travel tends to be after purchase goods and service tends to be a bit more than other categories. So here, the goal of data collection is to account for the emissions from the direct combustion of fuel or electricity from flights, trains, hotels, rental cars, etc., anything you use for business travel. Where possible, quantity should be recorded in the distance traveled, in the fuel volume consumed, and in the number of hotel nights. As specific as possible as you can get, that's always the best. And again, there's a few considerations to keep in mind specifically for law firms. So first, employee travel might be managed through a third-party travel agency that you have set up at your firm, like Concur. And that can help you consolidate the data that your employees use. And sometimes they can be very specific on the itineraries and the flight miles and the class type, etc. And then the second consideration is that travel that's booked through company issued credit cards, as I mentioned in the previous example, it's difficult to sometimes split that out from total operating expenses, leading to under or overestimations. So again, just honing back onto good bookkeeping and data cleaning is always going to be necessary specifically for this category. And then again, on the right, we've mapped the data items to the data hierarchy. So primary data would be travel carrier reported emissions split by the travel type. So for example, if you took a flight on Delta Airlines and you knew exactly the emissions that came from your specific flight, that would count as primary data. Hybrid data would include the, for example, the total distance traveled by transportation mode and the total hotel nights by country. And then we would combine that with an industry average emission factor. And then finally, spend base would just include the spend on business travel for flights, hotels, and so on and so forth. So now that we have a solid understanding of carbon accounting, I will hand it over to Christine, who's going to guide us through an introduction to target setting.
Yes, so thank you, Maninder, for that wonderful walkthrough of greenhouse gas accounting. As mentioned in an earlier slide, carbon accounting allows companies to accomplish many things, and among them include setting targets to reduce those emissions. And this is a perfect segue into the second topic of today's webinar, Introduction to Target Setting for both environmental and science-based targets. There we go. Oh, sorry guys, there seems to be a very severe lag on my end, but I think it has loaded. Okay. When it comes to climate, the science is telling us to act now, not wait. Human-induced warming continues to rise, and the most recent emissions gap report from the UN, this was just published last week, indicates that global nations remain far from the Paris Agreement. In fact, according to the Climate Action Tracker, which is here on the right, warming projections that consider current actions and policies aligns the globe with only 2.7 degrees Celsius by 2100. And this is well above our 1.5 degree target. Therefore, in active response to what climate science is telling us, setting targets to reduce the impact of our business's footprint is one of the strongest strategies to pursue. This is where I'd pause and say that no two companies are identical, and therefore no two companies' targets are identical either. In being mindful of all these differences across businesses and industries, Agendi developed what we call a funnel approach, which allows companies to approach target setting in a way that will be tailored and reflective of the business's operational realities and circumstances. There are 5 phases across this funnel, and we will be going through each one by one for the remainder of the webinar, starting with the first one and the most general one, introduction to the target setting landscape. Introduction to the target setting landscape is where we explore the high-level considerations for your firm's target. There are 3 main components. The first one is understanding the type of environmental target that you want to set. The second, what type of targets are commonly seen across the industry? And third, and last but not least, the framework that you would like to use as a guidepost for target development and achievement. As you may have seen across various public communications, there are many types of environmental targets to choose from, the most common being those related to carbon emissions reductions. So tying this back to what Maninder just presented on, companies should first understand their emissions across scopes 1, 2, and 3 before setting these types of emissions reduction targets. Only then would there be a clear quantitative goal to work towards. In addition to emissions reduction targets, companies can also choose to set goals on other environmental priorities. And this includes what you may consume across energy, waste, and water. This can also be based on social goals, which includes the type of organizations that you want to hold partnerships with, or even the diversity coverage within your employee headcount and or your C-suite leadership board. Sometimes it may be difficult to decide on a type of target without first having the right information to support that decision. And this is where peer benchmarking serves as a very useful tool towards informed selection. In the table here, we've gathered some examples that we've seen across law firms that already have existing targets. And many of these firms are pretty ambitious, seeking not only to reduce their emissions across scopes 1, 2, and 3, but they also choose to pursue reductions across waste, water, and energy consumption. Some have also set social targets. Clifford Chance, for example, seeks to have their senior leadership be at least 40% women and 40% men by 2030. When having internal discussions with your team on target setting, peer benchmarking results provide specific and objective insights, and this will help you realize realistic and comparable goals. The final main component of phase 1 is selecting the framework that you would like to use as a guidepost for target development and achievement. Earlier today in the webinar, you heard Maninder speak about the Science-Based Targets Initiative, otherwise known as the SBTI. The SBTI is a leading standard for emissions reduction targets, and it also represents a collaboration among leading organizations in the climate world. This includes WRI, who is a co-author of the Greenhouse Gas Protocol, which we also mentioned, the United Nations, and CDP. The SBTI is a targeting setting framework that allows companies to develop targets that are measurable and aligned with climate science. And in fact, all of the peers that were listed in the preceding peer benchmarking slide had their targets validated by the SBTI. Although it is a best practice framework, SBTI is not the only option out there. There are alternative target setting initiatives and programs that also demonstrate strong and trustworthy actions towards sustainability. RE100, for example, represents a large cohort of global companies that have committed to 100% renewable energy by a specified year. The True Zero Waste program is dedicated to recognizing waste management and reduction practices across global companies. So to kind of conclude on this slide, with all of these options available to pick from, what is most important for any company, any firm, is to select the one that makes the most sense for your business and the one that best represents your business's ambitions. Moving on to phase 2, this is where companies start developing a long list of targets and kind of narrowing down the list to identify the priority ones to move forward with. To help you narrow down your selection, there are some guiding questions that you can ask yourself and your team. These include understanding the why behind the target setting. Why is the firm setting targets? How does the target setting align with our overall business strategy and growth plans? What level of reductions, be across emissions, water, waste, etc., is feasible within our operations, both technically and financially? The when behind the timeline of this target and how that may align with expected growth. Are we expecting significant growth in the next 5 to 10 years? The how behind this will align with our value chain. Are we able to engage with and integrate our supply chain into our plans? And even some logistical concerns. Do we have the data and systems in place to measure progress consistently, both internally and externally? This is not an exhaustive list, but the answers to these questions, these preliminary questions, will help you solidify your options in a clear and meaningful way. I believe I saw a question come in, but I'm not sure if we should pause here to answer it, if it's relevant to the slide, or if we should keep it for the very end.
Let's hold that one to the end let's hold that one to the end.
Okay, no problem. Thank you for the question regardless. We'll get to it for sure.
We'll get to it.
Yep. Okay. In addition to identifying priority target options as part of the long list, this is also the part in the process where the target language is finalized for clear communication and for clear action plan development. A target can take many different forms, but they typically have these 5 key parameters shared across all of them. The first 2 are a little bit self-explanatory, which is our base year and our target year. The base year is the year in which progress is being compared to. This could be a historical year or could even be a current year, such as 2025. The target year is the year in which we would like to achieve the target by. As we saw in the peer benchmarking slide, many of the law firms have picked 2030 as their initial target year. The third item is scope of inclusion. What sort of activities do we want to capture within the target? Oftentimes, it's one of the 3 key scopes which Maninder presented on, scopes 1, scope 2, or scope 3. Sometimes it might be a little bit more specific, and maybe the target is tackling specific categories within scope 3. So not the entirety of scope 3, but maybe the key components of your scope 3 emissions. Fourth, the target type. This is typically what the target is, what form it takes, and generally it connects very well to how the target progress will be measured. The 3 main types that we typically see are absolute intensity and engagement. And last but not least, the ambition level. This is the degree of aspiration that your target would seek to achieve. Typically, this is in alignment with climate science and or best practice. For our discussion today, we have pulled for Latham and Watkins emissions target according to SBTI target dashboard. And just kind of pointing each of the components one by one through the bolded and underlined items, starting with the absolute target type. That ties into item number 4 here. Latham and Watkins chose to approach your target from an absolute reduction. The scope of inclusion, this target in particular is specifically only for scopes 1 and 2. Latham and Watkins does have a separate target altogether for their scope 3 emissions. The ambition level, the 50% comes from using the SBTI tool that's available publicly on their website. Again, it is aligned with climate science, so we're aware that this 50% reduction from between 2019 and 2030 is aligned with the ambition level of 1.5 degrees. And I've mentioned it already, the target year of 2030 and the base year of 2019. So this is a perfect example of how a target is effectively structured and clearly communicated to a public audience.
So I think this question is relevant now. So they used SBTI to, help get their ambition level set. And the question is, are you aware of any alternatives to SBTI for general carbon footprint, scope 1, 2, and 3, or the net zero targets? Are there other alternatives than what Latham used here?
Great question. So in terms of climate tools and science-based tools, SBTI remains the best practice and kind of the gold standard out in the public domain. Other frameworks are available that we've pointed to in an earlier slide, but more often than not, they don't have a downloadable tool for you to reference and kind of plug in your data, and it tells you numerically what your target or your emissions footprint should look like by the target year. So what we typically do for a lot of companies and or law firms who are interested in setting their emissions target, but not necessarily to the ambition of SBTI, will use SBTI as a baseline, kind of understand what the most ambitious target you can set alongside a 1.5 degree pathway may be. And you can take it by baby steps. Maybe the tool is telling you 50% reduction by 2030 by using a 2019 base year. You don't have to do 50%. You can start slower at 25%, but at least you know that that reduction will eventually add up and bring you to the 50%.
Thank you.
Does that answer your question? Great. With that, let's move on to our next slide, which also brings us to our third phase. Now that our long list of target options have been identified and properly structured with our key parameters, this is the phase where we consider the feasibility of our target options at a deeper level. Because essentially for each of our options, we have a start point and an end point. The start point being where we started with our base year and the end point being our target year. By considering things like operational impacts, financial implications, and technological feasibility, we enable ourselves to figure out how to get from point A to point B. Depending on your company, your business, and your different aspirations, this process may involve communicating with various internal teams to understand the level of effort that may be required, figuring out how to best allocate resources for long-term success, ascertaining how working towards this target may align with wider business goals. For example, maybe a goal of the business 1 year is to reduce costs, operational costs. How does working towards this target tie into that? Maybe energy efficiency measures can also bring down costs and lead to cost savings. This process can also include defining interim time horizons, because oftentimes it might be a 5 to 10 year gap between your base year and your target year. It's useful to have these milestones to ensure that you're progressing alongside expectations. There we go. And this is essentially the bridge between the previous phase and the current phase, because by assessing the feasibility of our target options, we will simultaneously enter the phase of decarbonization roadmaps, because we're gathering everything that we collected in phase 3 and converting them into something that we can plan and track toward target achievement. Environmental targets, much like other business goals, are not achieved overnight. Success is met when practical step-by-step initiatives are taken together. And this graph represents an illustrative example of how planning multiple actions can yield long-term achievement. So going from left to right, maybe we start with electrification, and that brings our emissions down by an X percentage. The next step would be pursue more ambitious electrification through renewable energy, and this might be market-based measures through RECs or PPAs. After addressing your operational emissions, the next step would be to looking at your value chain emissions. Meninder mentioned it earlier, but something that we typically seen across law firms is business travel is a large component of Scope 3. So maybe enacting or implementing a low carbon business travel policy among employees can help bring down emissions by another percentage. And then, just a purely illustrative example, but supplier engagement has also proven to be a large component in a lot of Scope 3 targets that we've seen, because we as businesses in this world, we work a lot with our vendors and suppliers. And so all of that business transaction feeds into our category 1 by engaging with our suppliers to ensure that they too have their own sustainability and climate commitments. You're creating a very robust value chain overall and making your own business more robust to any climate risks that may occur. So this projective exercise ideally is conducted across each and every single one of the target options in your long list, because by doing that, companies can kind of confidently balance and plan ahead and ultimately select the target options that are best for the business to move forward with. I have lost my cursor. There we go. Finally, our 5th and last phase in the funnel approach is the target finalization and communication. In the realm of sustainability and climate, there is an underlying message that these targets, actions, initiatives, etc., are complementary to the overall business. Therefore, where climate is an active and embedded consideration, there is long-term synergy that can result in other strategic benefits as well. For example, by investing into energy reduction practices and renewable energy consumption, a business not only decreases their emissions footprint, but may find themselves experiencing increased efficiency across operations, and thus cost savings. As sustainability continues to be continues to garner interest across stakeholders and customers, a climate-aware business may inherently be well-positioned against possible risks in the market and gain a competitive advantage. And alongside this benefit, exploration into additional products and services through a sustainability lens can also open new doors, driving up not only innovation, but also possible new revenue streams. All of these complementary strategic benefits helps finalize the target, especially when it comes to communicating these internally to your leadership team and your wider workforce. Speaking about communication, there are many global law firms who have already taken to their annual public reporting to share their goals and their progress. Some of the examples are included in the slide here. This external communication not only demonstrates transparency, but also showcases accountability and trusted performance. Depending on whether there are regulatory or stakeholder pressures on your business, communication with targets also have an option of remaining strictly internal. And in these instances, environmental targets are often used as milestones that drive your company's mission, vision, and values. So with that brings us to the conclusion of our webinar. And we'll open the floor up to a quick 10-minute Q&A.
So I have a question. As we were talking about before we actually came online, we believe the sustainability is just plain old good business for the reasons that you showed in that last slide. So what kind of support do you give your clients to help them actually respond to RFPs? Do you help produce reports or concise descriptions of sustainability programs so that they can insert them into RFP responses and things like that?
Yeah. Maninder, I'm happy to take this and maybe you can
Yeah.
add your thoughts afterwards. But yes, we do support our clients across any RFP requests that may come their way, and it's very, very customer, company, and industry specific. This is not specific for law firms, but I can think of a particular example where our client received an RFP from one of their key clients that they had to start implementing renewable energy on project sites. So we went ahead using our expertise in the renewable energy market, especially market-based instruments, to support them in that manner. I know it's very different depending on what you may be exposed to, but that's just one of the many examples where we support.
That's great. Thank you.
Great question. Yes. Oliver?
Hi, yes, can you hear me okay?
Yes, perfect.
Great. Let me see if my camera works as well. There we go. Hi guys. Thank you for the
Hello.
presentation.
Yeah,
Really
welcome,
interesting.
welcome.
So my question is more around sort of quantifying target setting. Because so I work for Clyde & Co. We're also a global law firm, and we do have net zero SBTI validated net zero targets, but we work a lot with our suppliers who are smaller than us and maybe don't have the resources, because we had a fair amount of consultant support in terms of quantifying and just like deciding what's realistic in terms of a reduction, and kind of with the chart that you showed of sort of plotting your way to the required reduction. I think a lot of companies would have problems kind of knowing where to start in terms of quantifying them. And I know from the examples you showed, a lot of reduction targets tend to look quite similar, kind of around about 50% by 2030 and onward from there. But yeah, are there any kind of standards, if you like, or resources that are available to companies looking to do that, or would you suggest that they engage consultant support such as yourselves?
There are definitely a great question, Oliver. I'll start with that. There are definitely a lot of different resources that you can rely on. It sounds like this company in particular is already referring to SBTi's net zero standard because they have a validated target. Typically, what we would suggest is starting with the low-hanging fruit, which typically for law firms falls under scopes 1 and 2. Your operational emissions, what can you directly control? Because scope 3, as Maninder mentioned, is a larger beast in and of itself, just because of the number of players involved. So typically our general approach is understanding your scopes 1 and 2 to begin with. What is the sort of leverage that you have on these sites? Are you the lessor or the lessee? Starting with electrification, because that's not a drive only for tenants, but it's also a drive for the building management themselves. It does not only is it a competitive advantage aspect for them, but also reduces their costs. So kind of pitching that, working with your landlord in that way. And then additionally under scopes 1 and 2, that's where we look at renewable energy. Oliver, you also mentioned that like a lot of the suppliers that this client is working with is on the smaller scale. We completely hear you. We work with many, many clients in that way. And oftentimes what they need is something similar to this educational support, helping them set their own reduction targets, because we want to make sure that this target's not only benefiting me, but also benefiting you as my value chain member. It has to be synergetic, as I like to put it. So we often find times that like supplier engagement programs are pretty useful in that way, kind of giving them these resources and then assessing what's feasible for them. Maybe they start with scopes 1 and 2 at first, just like you, before moving on to scope 3.
Great, thank you.
Of course. Maninder, I wasn't sure if you had anything else to add to that.
No, I would just say on the supplier engagement side, we definitely have helped support some of our clients with those webinars. So like creating materials for them, educational materials, whether that's recorded webinars or presentations, or kind of holding their hands a bit in terms of like setting their own targets or understanding the whole mission and vision of your firm. So I would say definitely lean into that as you get closer to thinking more about scope 3 after your operational emissions, like Christine mentioned.
Great, thank you.
Yeah, and Oliver, it sounds you've been on a couple of these webinars, and it sounds like you've got a very sophisticated sustainability operation. So kudos to you. What we've had to do is start to incorporate some of these sustainability initiatives into our contracts. So we get specific lease language in our leases that the landlord is obligated to help us report on our carbon emissions. And it's really helpful up front, because then they have to start thinking about how they're gonna report to us on certain items, before, the day we ask. I've also noticed that some of these travel agencies have different reporting capabilities. So if you're going to go out to bid on your travel program again, I mean, it's a really good idea to, level set some sustainability objectives in that contract and make sure that they're able to report the way you want, your carbon emissions for travel reported on, not the way they want to report on it. We talked about FedEx, UPS. I know FedEx was super helpful, but I'm sure that UPS, if you're renegotiating a contract, you can negotiate in that it's a free carbon assessment as opposed to a carbon assessment for a charge. So those are other ways to engage with your suppliers.
Any other questions?
I know that one of our members that's on was going to was considering doing some carbon offset credits. And do you have any advice for somebody that's looking to buy carbon offset credits and what to look out for? Any kind of pitfalls in terms of quality or
Absolutely.
what to look out for so that you get RECs that you can actually use as a part of your sustainability initiative?
Yeah, we understand that the offsetting space is a really complex space to understand, from not just from a buyer perspective, but just as someone that's in sustainability and doing this work. It's confusing for me too sometimes. So Agendi does have an offsets procurement branch of our business where we help our clients procure offsets. So that's definitely something that we help our clients with. We know that there's a lot of players in the space, whether that's, on the developer side, there's always new technology coming out, or on the procurement side or the platform side, there's a lot of technology platforms out there specifically for vetting the quality of carbon offsets. So there's definitely a lot of resources out there, but of course, ensuring that offsets are, additional, that they are vetted by agencies like Gold Standard and Verra. That is one of the surefire ways to ensure their quality. But I would say having someone that you can, whether it's a consultant or someone that you can ask for assistance, whether it's a platform or something like that, on procuring offsets and RECs especially. I know that offsets sometimes get a bad rep, but I would say that the quality is definitely there, and there are ways to ensure that you're getting the benefits of them as well as the co-benefits of them. So it's really just about ensuring that you have all the knowledge. And we've done some webinars on RECs procurement, and we're happy to share those materials as well, or do a separate webinar on offsets as well. Christine, did you want to add anything to that?
You captured it perfectly, Leonard. I think I'll maybe add two quick things. You mentioned vetting the quality. That is definitely where we advise starting with when it comes to the carbon offset sort of discussion, given the amount of scrutiny around it. There is a clear distinction though between RECs and offsets, especially now that we have mentioned net zero target. RECs is widely recognized as renewable energy. It's a market-based instrument for renewable energy and can be used to decarbonize your emissions footprint. Offsets, on the other hand, is strictly balancing. So it cannot be counted as decarbonization. And in that way, this is another thing that we would advise a lot of our clients that are looking into this space is, have you done everything in your power to decarbonize first before exploring the offset option? Because of the scrutiny of the cost and also what it represents when it comes to your overall target progress, there is a different meaning. And then the other sub thing I'll add, because this is a question about someone just looking into exploring the carbon offset space. Carbon offsets is inherently supporting a lot of different projects out there, which have UN SDGs applied to them. So there is a community benefit. You might be supporting some underrepresented families here, or it might be introducing technologies in areas that may need it. Depending on this particular organization's interests and ambitions, they might want to align themselves with a carbon offset project whose narrative echoes with their mission and values. So I would probably throw those two components into the hat for consideration.
Yeah.
Well, we'd love to have you back again because this was just one of the best presentations we've had in a long time. So
Oh, thank you.
Thank you.
we appreciate you both for your time today and for your expertise. If one last call out for questions, and otherwise, I think it just was a great presentation, and thank you so much.
Yeah, thank you so much, Doug.
Likewise, thank you.
The LSN team for hosting us. We hope this session was insightful. Of course, it's going to be recorded and shared with the members. We know that this was more of a foundational webinar on topics like accounting and target setting, which some of you might be mature in your sustainability strategies. You've already maybe thought of those things. We're happy to come back and focus on more on topics that your firms are thinking about, whether it's transition planning or materiality assessment or anything that's compliance related. We do pretty much anything and everything across the ESG space. So please look out for an email from us for this deck and get in touch with myself or Christine, or if you have any questions, you can also book time with us directly free of charge, which is linked here. So we appreciate you taking the time, and have a lovely rest of your week. Thanks so much.
Thank you.
Thank you.
Thank you, everybody.